Just on Teck, I've got to ask you. So let's just assume everything goes through. They're going to have a $7 billion added to their war chest. You mentioned the Chilean asset. That's obviously, already developed. Everyone knows it's a T1 asset. But can you foresee any kind of set of circumstances that they would then, perhaps not in coal, but start to get acquisitive? Because I know it's very toppy prices at the moment because you've got this massive hunt for those kinds of assets. But does it make sense for Teck to look for perhaps some of these greenfields or some of these junior explorers that perhaps sitting on a decent enough prospective deposit?
When you've got $7 billion in your pocket, it starts to burn a bit of a hole in it, right? And so, there's some of that will come back to shareholders for sure by way of a special dividend. Teck has its own project pipeline that it's going to move forward. But that said, though, the major capital spend is behind them. And so they are, and they are losing 60% of their revenue through hiving off the coal business. And, they want to get a running start on this. I have no doubt that they will look around the metal space, the copper space, and see if there's anything that they could pick up that would help them build scale faster.
Just finally, can I just ask you, because obviously Glencore's plans are interesting in and of itself. It's very strategic in terms of, buying these coal assets, all of the synergies that they get. They get that met coal, which is obviously going to have a much longer life if we believe all of the environmental noise about trying to phase out thermal coal. But in terms of what you would foresee the demand would be for, they're going to be listing it on the NASDAQ. Do you foresee that there's going to be a lot of take-up from investors for a pure play coal company of sorts because it does have that thermal and met mix?
Look, if they structure this coal company the way Teck was going to, this is going to be a pure cash flow vehicle as they run it down. And, it's going to be a multi-generational cash flow vehicle with free cash flow yields, in the north of 20% range. In my view, and having talked to, investors all across North America, as well as around the world, there is a significant appetite for a free cash flow vehicle. There are lots of funds out there, particularly now, that are focused more on the free cash flow side of things and are less constrained on the ESG front.